Auckland property prices. Whoa, never be able to afford our own home. Maybe, but not so fast. Hey guys, it's Matt here from the 150 Group, independent mortgage broker, and in this video I'm just going to run through what's called a family equity loan, or an 80-20, what we call it in the industry, or you may have heard the phrase thrown around, the bank of mum and dad. So what is it? It's essentially whereby you guys get into a property sooner rather than later, or a whole lot quicker than what some of you may have thought possible, by using security or equity in your parents' property to make up the deposit. So yes, I appreciate this is not going to be applicable for a few of us out there, but for those that it hopefully is, this is how we do it. Of course, why? As you know, I'm sure, the loan-to-value restrictions in place at the moment says that we need 20% deposit in order to buy a property, especially here in Auckland. Well, hey, don't get me wrong, as mortgage brokers, we can definitely get it done if you only have a 10% deposit and you have good income. But straight away, be aware you're going to get hit with what's called low equity fees or low equity premiums. This is where the bank charges you a penalty because you don't have a 20% deposit. The more you borrow, or the higher the LVR, the more they're going to charge you. Also, this might be a new concept to some. Basically, it's what we call the cost to wait. This is whereby someone is trying to save themselves, and it's obviously going to take them a while to save the deposit, but they don't realize, but they're actually being pushed out of the market by waiting. So it's costing them money by waiting, if that makes sense. What I mean by that is, year on year, property prices in Auckland have been increasing on average by 15%. Of course, in pockets, a whole lot more than that. So for example, last year, someone looking at a property for $500,000, well, now that same property, all things being equal, is going to be worth at least $575,000. So I don't know about you, but I don't know many couples that were both working full-time that can save $75,000 within just 1 year. So this is how we do it. This is the answer to the problem. Example: we want to buy that $500,000 property, but we've only got $20,000 saved up ourselves. So what we can do, which is of course, $20,000 is well short of the $100,000 required, or the 20% of $500,000. So what we can do, we can raise a mortgage of just $80,000 against mum and dad's home. We can structure this to be paid off within just 5 or 10 years by you guys. And the owner on the legal documents would be you, your partner if applicable, and of course your parents jointly. So in this case here, the parents are only liable for 16% of the $500,000. Whereas you guys would be liable for $400,000, which is of course 80%. Would structure this on a 25 or 30 year loan term, and of course the owners of this portion of the mortgage will be yourself and of course your partner if applicable. So just to reiterate, you guys are paying off both mortgages, this one as well as this one. But we're getting past the LVR restriction by using, or piggybacking off of mum and dad. We're using this $80,000 here as security, so we get to borrow a whole lot more. That's what the banks are concerned about. The banks are concerned about their own backs, security. Yep. Benefits, why would we do this? Pretty obvious by now, I'm sure. You guys are going to get onto the property ladder a whole lot sooner. You're going to start building equity in your home, which is of course what it's all about. Parents, hey, great, you get to assist your children. How cool is that? And of course, just remember, parents, you're not using any of your own cash. The banks don't look at how much money you actually have in your savings account or your check account. They're looking at the equity in your home. In saying that though, what are the risks? Well, let's straight away jump to the worst case scenario. The kids default on the mortgage repayments. So straight away, the parents are going to be liable for the repayments for the smaller loan over their property. So if you remember this one here, $80,000, you'll find the repayments for that. If we change this loan term from a 5 to 10 year, let's say we change the loan term to maybe 15 years or 20, on $80,000, the repayments roughly, I'm guessing, it's going to be about $100 a week. The bank wouldn't even approve this application anyway if the parents couldn't at least afford $100 a week. So of course what it's all about is having the equity in the parents' property or in the parents' home. And of course, we'd always look at mitigating these risks with appropriate life, medical, income protection insurances. Statistically, if someone defaults on their mortgage, it's due to a loss of income. If it's a redundancy, yeah, hey, it can be scary being off work or off your job for a while, but here in Auckland, hey, chances are it's not going to be long term. And yeah, once again, we can mitigate these risks from an insurance point of view as well. But hey, hope this has been helpful, guys. Leave me a question or a comment, and I'll respond to it myself. Otherwise, bye for now, and thanks so much for watching. Cheers. Bye.